All right, good evening, guys. Ken at Tortoise Capital, small group coaching, cohort 1, July 22nd, 2024. Got a full house. So I'll be brief on my check-in. All is well. Published the mechanical swing trading book. I think I sent it to everybody. I think I've hung it in the coaching workshop. If I haven't, I will do it. I made a note to do it. And I'm at a certain age where thinking about wanting to do it is the same as having done it. So I'll double check on that. Make sure you get a hold of it. The next book in that series is going to be all of the advanced swing techniques, like the slope stat and the alpha stat, hybrid trading, the use of system quality numbers for finding stealth candidates, and all that. So there's that. I had a note from Danny. He's Danny Ben Yair. He's the super trader that's done the TC 2000 bundle. He's in Israel, and his hedge fund advisory service is starting to take off, and it's consuming more of his time, and he doesn't feel that he can continue to kind of support the TC 2000 bundle with any more clients. So what I asked him to do is let's give folks a chance in July for any final sales of that before we close up shop on that one. I'm a big believer in Edge Raider. I really like what it does for a very focused set of strategies and framing. I think it's a pretty robust package. It does back testing that TC 2000 doesn't do. But I will say that the TC 2000 bundle has all of the advanced techniques like system quality number and all the alpha stat and slope stat, which I think, in my view, is the ultimate secret weapon. So I would be remiss if I didn't mention that the last day to buy that is July 31st. We got it on a 40% sale to just cut people some slack. I'm talking to a couple super traders already to see if they might be interested in talking to Danny about taking over the ownership or management and maintenance of that package, so that it's might still be available in the future. I haven't heard back from Danny on that yet. I don't know what he wants to do. But it occurred to me after I had talked with him about the using the 31st as the end date of that thing. There are other ways to get that data. None of them is slick and as well integrated as the TC 2000 package. And what he's done with that package, just the way he's used their coding language and all that, is so elegant. And he basically uses that package for his business of advising hedge funds, which is where that thing came about. And he's been using it for almost 10 years. Anyway, that's what I wanted to say about that one. All is well here. Daughter had her first day of med school. We're excited about that. She got her white coat on Friday. They had an elaborate ceremony. And then they ended up with, after everybody was patting each other on the back and excited and nervous, and classes begin Monday. Let's go. So all the hype and the stress and the anxiety is over. Now it's just 4 years of hard work, which is certainly manageable. So she's in a good space. I'm using that confident communication and professional performance model to help coach her through that. We actually had that was one of the motivations for getting that thing done. And it actually is, the more and more I look at it, the more I like it. Holy smokes. So more to follow on that one. All right. Over to you guys. Let's do a quick round the horn for check-in and then jump into presentations. And let's just do a check-in when it's your turn to do the whatever you're going to present on, and that way we'll just get on with things. Okay, here we go.
Well, I can go first today.
Okay.
I've got a few things working on this week. A couple things are just some continuing things I'm trying to think about, and I finally kind of wrote them down, and uh, I sent some of this to Ken just right before the class. But one of the things I really need to get clear on is this. Some of this has to do with my prep, but what it really means to not have a directional bias for day trading. So, we have if you have time frames above you that are in compound critical states, or maybe multiple that are compound critical states, or in a pattern. If you're down on the 3-minute time frame, then you could get an outsized move, boosted by that, and that makes sense to me. On the other hand, in a lot of respects, the 3 minutes time frame is really noise. I think to the 30-minute and to the daily time frame, and it's going to do whatever it is that it wants to do. You could have higher time frames that are trending up, but on that particular day, 3-minute maybe oscillating. It's going against the trend. So, the time that I'm taking to evaluate the things that I'm looking at, and really looking at all the time, all the things that you can evaluate. It seems like as soon as the market opens, I don't know that it really matters, because you just got to trade. You just need to trade what it is that you're seeing on a 3-minute time frame. So my thought is, really what's important is that I've got support and resistance levels for the higher time frame. So I have some targets, and I have an idea where the buyers and sellers may be. But when the market opens, maybe I just need to really just ignore, or not really ignore, but just put aside whatever it is that I saw on the higher time frames, and just really trade the 3-minute time frames, and just whatever moves, it opens and it goes short. And maybe the 30-minute was in an SSC. It doesn't matter. I'm going short, because that's the behavior that I'm seeing on the 3-minute time frame.
Yeah, that is
I hope that makes sense.
100% true. That's 100% true. And
Okay.
and the reason for it is what you said. The 3-minute bars and the daily box, as long as it's inside yesterday's range, inside that box, price is just random noise generator until it breaks out of yesterday's range. Until it breaks out of yesterday's range, the higher time frames have no new information about any potential directional move. They are just not even paying attention until that thing leaves the station. It has to make a higher high or a lower low to begin to get their first bit of attention. Now, the world inside that box, inhabited by robots and day traders, is looking at as the outer limits of the universe. Like,
Okay.
or the galaxy is probably better. That's the galactic barrier. It takes something different today to break out of yesterday's box. There had to have been new information available,
Okay.
or a new market participant who has access to news that we haven't seen, or a new order comes in for whatever reason, is these guys got to come in and start making decisions, because they're trading for large funds, large banks, whatever. So new information has to come into the box to make it move out of the box. But if no new information comes in, by default, that thing is going to stay inside yesterday's range. Well, what can we do with that? Well, that's where the statistics of the daily range give us the dimensions of that space. It gives us key support and resistance levels and turning points Like if it gaps down and sells off quickly and is approaching yesterday's low, but doesn't break out of that, that's information about the inside of the box. And my pattern is just to say, well, it just held support where it held support yesterday. I'm not allowed to be surprised by that. How far is it from yesterday's low? Is it less than a frog box? I hope so, because that means there's at least 3 full frog boxes to yesterday's high, probably, or whatever the distance is to yesterday's high. That's the reward, and the risk is how far it is from the low of the day. And do I have a statistically reliable, disciplined pattern that tells me that I can buy in the second mouse position? That's what the SSC is. The
Yeah,
SSC is the second mouse. The Kata 2 is kind of like the third mouse, because there was already a successful second mouse pause and then is continuing. So now that's the third mouse coming in on the Kata 2s. Well, that all of that intraday drama that we're making meaning out of is noise to all the non-day traders, which is 95%. I don't know what the number is. Pick a number. 90% of the 95% of the money in the world
yeah,
is not even paying attention until it comes out of that box. So why do we care about the 10-day look back, the monthly look back, the 150-day high and low, the different, well, because those represent significant areas of support and resistance and decision making for all of that other money. So if we're in a position in sniper trading where we have price and volatility in a location that is significant to all those demographics and the intraday, now suddenly we're in a minefield. And if price breaks above or below a certain level, that could start triggering all those other guys and money could start coming in. So that's why you have to have a non-directional bias intraday until it breaks out of yesterday's high or low. Until it breaks out of yesterday's range, I have no information that tells me that I'm justified in a directional move occurring. I have to see evidence of that. But meanwhile, the daily box may be so large and my minimum manageable risk box can be so small that I can sort of just harvest the intraday noise. It just sounds like it's the kids these days in their music. It just sounds like noise to me. Well, that's because you haven't looked into it deeply enough and slowed it down and detected the patterns that are significant to them. Like metal drumming is 400 beats a minute. I can't figure it too much. But if you slow it down, you can start seeing those little patterns. And because they're fractal, we get to see what a statistically significant turning point looks like for the second mouse. There was a significant move in one direction, which stopped, and the dragon starts to curl and all that stuff, and the SOC happens. Goddamn, that's simple reward to risk on the next possible move. I have enough information to act on the intraday scenario. That's what the statistical view of the intraday trade is based on. Nothing more than how far do these little electrons randomly move until they stop moving that direction and move the other direction. The daily frame, the daily box, represents the sort of a galactic barrier that keeps all that noise contained inside the cylinder, where the piston is just moving up and down, going through the little cycle of
okay.
compression, combustion, power, and exhaust. That's all it's doing. It's just mindlessly driving that little engine as guys are adjusting positions. Some guys have to buy today, some guys have to sell today as part of their normal duty. There are also guys intraday that are trying to make it move around and take advantage of the smaller moves like we are. So there's sort of routine things happening routinely. When it breaks out of yesterday's range, I now have new information about um, a possible directional move beginning, because that's what it has to look like. It's not a directional move on the longer term timeframes until it breaks out of yesterday's high.
Okay, okay.
The added advantage of the 30-minute bar is that over the last 3 or 4 days, you can start seeing where multiple turning points occurred, at the top and at the bottom. You start getting a sense of, is it leaning one way or the other? Where are those critical points from the last 3 or 4 days? When the market has been sideways and choppy, you'll see a lot of those. You'll see those forming different support and resistance within a sideways channel. If you had a 3 or 4 day directional move, all you're going to see is a series of damn cotta twos. It just keeps going and going and going. Say, well, of course. And then today, the 5th day, that thing rolls over and starts cranking back. You say, oh, well, maybe that was that. Now this is the next thing. Now I'm thinking of reversion to the mean, the middle of the range. Where's the bottom of that thing? And you can start using those higher time frame support and resistance to start looking for signposts on the road that's under construction. Can't even see it, but you can see it's like a road crew is out there getting ready to pave the road that price is going to drive on. Where are they have to follow the terrain. They're starting to put markers in there where they're going to make a curve. And so you can sort of anticipate that's where the curve would be, is if this is just a normal retracement and then back to support, where would that be? Okay, so if it does that, you're not allowed to be surprised by the fact that it does what it always does. But you can't, that's not predictive, it's descriptive and anticipatory, but there's no mathematical basis for saying it must go to there. And that's what I think guys that do a lot of back testing and try to overvalue statistics and all that. They're trying to get predictive statistics and saying there's a 70% chance that it gets there. That doesn't even mean anything. Just the fact that it could go there and not be surprised. It's somewhere between a 20% and an 80% chance of getting there. You pick a number, it doesn't matter. It's a non-controversial move that if it went there. It would be non-controversial if it only went halfway. Because essentially we're looking at price banging around inside a metal can, a noise generator. So that's why you just eliminate the concept of directional bias altogether until such time as we get a signal that the higher time frame has begun a directional move, which only begins when it breaks out of yesterday's higher low. So,
Okay.
so the 3-minute time frame is what you do know right at the open, based on the size of the gap, is whether or not it's in an agitated state. It's already in an energetic state. Like they had a double shot of espresso and are ready to. Why? Because there was a bunch of noise and the gap signals that there was a lot of processing that had to be done to adjust positions based on whatever happened in the last 48 hours. So you got to have that to say. And everything outside of day trading, whether you're doing 30-minute swing trading all the way up to monthly bars, all of those things care about all of the previous support and resistance levels for their various look back periods. It's and now it's not like yesterday's high or low. It's now new 10-day high and low, or 30-day high and low, or monthly high and low, or yearly high. Those things now, that's where that multi-time frame, multi-lens analysis starts letting us know where those um, energetic points are, those power ups you know, the little Pac-Man bites it now, he's super, off he goes. So that's the distinction between that intraday completely separate world. And every swing trader and above just says, you know what? I can't handle that. It's just going to be noise to me. I don't even care until it comes out of it. And that's why sort of a reasonable default position on a swing trade is start at 2 ATR. So now it takes two full sort of like maximum reasonable daily range, including the gaps. I need two of those in the adverse direction away from my primary hypothetical direction. I mean, when I'm a swing trader and I get my little entry signal, it has to be because there's a 4 ATR gain in the direction that I want to go for reasons you pick in order to justify a 2-to-1 reward to risk. If I'm using 2 ATRs as my adverse price action that gets me out of a swing trade, well, why is that right? Well, that's right just on a statistical basis and money management. It says there are reasons to believe that this thing is going to go long and that it could go 4 ATR because I look back and I see the size of previous moves and I see where the next support resistance is. And whatever reason, I think a 4 ATR move over the next couple weeks could happen. That means out of a 10-day trading window, if 6 of them were choppy, but 4 of them were directional of a full ATR, that would give me a 4 ATR move in my favor over the next 10 days. And that would be a completely rational, normal swing trade, not unusual. And so if that's what I could reasonably expect to get under normal conditions over the next 10 days, then then I do have a directional bias on that kind of a trade. And what I'm going to pick is 2 ATRs, which says I'm going to pick a wide enough stop that the normal noise of a couple days of trading in a row aren't going to kick me out. It takes really 3 days of adverse directional movement to get you out of a 2 ATR initial stop. So I'm going to say if it moved 3 days in a row against me, like a full daily range, okay, that's going to get me out. My hypothesis is over. So I'm picking a deliberately wide stop in order to ignore all of the intraday noise because I don't want to be watching the market every day. That means I have to trade off that wider stop and a smaller position size and staying in the trade longer in order to get the 4 ATR, which means I now have a smaller position size, which means I have more that I could manage because it doesn't take very long to evaluate the swing trade. I don't have to watch it every second. And my position sizes are smaller, so the individual risk of a trade is low. So if I have some diversified symbols and diversified signals, some are momentum long, some are value plays at reverse, some are maybe short. So I've got some diversification in my target selection and in my system selection. Now I can afford to just let them cook for a while on a slow cooker. But I have to have more positions now to get all my money at work and to give me the genuine diversification I need. So swing trading, I've got, unless I'm doing some kind of Z3 pinch breakout where I'm going to go in either direction because it was a critical. Now, if I'm a sniper, I'm playing a volatility breakout. But most other swing trades are based on some hypothesis that because of the market and sector and target condition, I have reason to believe that that directional move is going to be in my favor and it's going to be large.
Okay.
Like the buy on dip, the channeling is not based on the idea that if it fails, that thing is going to collapse and go to zero. No, it's just this thing has drifted. It's in a strong bull. It has drifted down without volatility to a natural buy it on sale dip. So I'm just going to routinely add to that position because the move is up. That's not a theory that says that thing is in a critical state and it could go large in either direction. That is not a critical state on a swing trade. A Z3 pinch, a super pinch on a daily chart, that's a compound critical state. I'm going to be ready to trade that in either direction, advanced technique. So normal to have a directional bias each day if I'm swing trading, because it's part of a larger move that's already unfolding and is showing me it's the market's preference for one direction. Intraday, none of that counts. None. All you know is where it's like a pinball. Where are the bumpers at? What's the dimensions of the normal move? If yesterday was a doji, I'm really prepared to think this could be the beginning of a directional move when it breaks out, because it was quiet and now it isn't. It broke out of yesterday's high. That's the beginning of what could be a compound good move. I love a doji. The guys in the swing trade workshop, I think you saw, showed that if you prefer dojis as your setup day, all of the patterns are better. Yes, that's true. Because your position size is bigger, because your risk box is smaller, and because the market compressed and now it's beginning to make a directional move. The spring compressed and is starting to expand. So yes, your insight is correct.
Okay.
Intraday, different mindset. It's an ammo box or a trash can, and it's just banging around, and it's no information. I don't even know what's in the can and why it's making noise. Is that a bobcat that's in there chasing a rabbit that ran in there? Is it some kids threw I don't know, two dogs fighting over a bone? I don't know.
Well, that clicks, and so it sounds like I'm on the right track.
Yeah,
That really, for whatever it is that I'm trading on a 3 minute, I have my support resistance levels that I'm using, and that's my prep. I'm done, and then that frees me up to be in the flow of the market,
yeah,
whatever it is that's
yeah.
doing.
Just put
I'm
a
just
thick red bar at yesterday's low and stretch it all the way across today's chart at the open. Just make a big if it goes below that red bar, I now am entitled to start thinking about a directional move going that way.
And that kind of brings me to the second issue. We talked about it some last week about how many symbols I'm trading.
Yeah.
I was trying to do three. I did that some more last week, and I decided that I'm just not doing well with three. I'm not ready to do
Yeah.
that. I did it today. I just was going to do EWW and DIA today, and
Yeah.
I had XLE sort of in the corner,
Yeah.
and I just happened to see that it was making an SSC, so I got in that. So then I'm trading three again. But when I do that, then I'm kind of trying to pick trades, and I'm seeing multiple signals or multiple possible signals, and I don't want to have three
Yeah.
trades.
So if you
So
do that, and you see XLE and you decide to shift to that, cut the other one off completely and never look at it the rest of the day. Go for the one that's moving now, commit to that and one, so you're only trading two, but the other one just drops off like a wing tank. So you're not trying to hold three in your mind.
well, this
Use
is the
three,
thing.
pick the first two, and just drop the other one for that day.
Well, if I'm just sort of trading the noise, so to speak, then yes, if I'm trading a big mover, I'm going to do better. And it's sort of like the thing that you don't want to do. I'm trying to balance the thing that you don't want to do is the thing you need to do versus I really don't want to do that. I should be doing the thing that I want to do. If I've got a couple of names that I'm trading and I'm trading noise, then it doesn't really matter the things that I know really well and I know how they move and I'm able to trade them effectively.
Well, it's
And
just
I
that,
do with increase my
except it's
advantage.
just that your familiarity with them is like an experiential basis that supports your statistical understanding. You know,
Yeah.
the numbers tell me this thing could move $2, but my experience also tells me, yeah, that's a $2 move, and that's about where it normally starts to fail. And so the combination of that quantitative and qualitative, the thinking and the feeling reinforces your expert. And it's really just designed for you to act decisively quickly at
Yeah.
low energy cost for the decision. So you're not suffering on each and every this is where I make the decision, I go for it, I got a thick skin.
Right.
And that's kind of the mindset you got to have for the intraday.
I guess the bottom line is you don't necessarily need more than a couple of or a few symbols. If
Yeah.
there's that are trading well, that's it.
Yeah, and
You're
that's why of the ones that we pick, DIA, because it is so large and orderly and directional when it does move. And then EWW and EWZ are not the US. They are independent of each other, and they are very volatile, large ranges, and directional. So it gives you, that's kind of it's like you go to the dog track to bet on the greyhounds, not the corgis. I mean, the corgis are fun, but you go to bet on the greyhounds. That's because of the speed and size. So yeah, you're on the right track.
great. Oh, great. So thank you very much. That really helped.
Next man,
I can go next.
in church.
So I've been continuing trading my system. I've sort of decided that I'm not very happy with the results. It hasn't made very much, hasn't been very profitable. So I'm looking for ways to improve it. And one of the things I'm thinking is it's over trading. This is trades today for CLF, which was overall negative. So I'm thinking about reducing the number of trades.
Yeah, I mean, I'm just going to start with that first trade. The first entry is absolutely perfect. When the R10 reverses and then price hits the dragon, you exit. That's one trade and it wins. At
Yep.
the entry at like 7 or 6:45. Yeah, that
Mhm.
first entry is perfect. New low of the day. It's a collapsing dragon. It gives you two sharp bars to the straight down. That's probably two our favorable excursion. Then it gives you an orderly reversal, essentially at that second red dot. And then it goes up and hits the skin of the dragon. So that third red circle is the exit for the first trade. Done. It is a absolutely clear signal with a simple rule. And then where the green dot is probably one bar early on a SSC, although I could live with that one. I love that as an entry with a stop at the PSAR. And then the second entry is perfect. And where that should get out is when go to where the R10 reverses. No, at the peak of the R10, right there, it's the R10 stopped going up. So get out when it hits the dragon. Next bar. Out. Two entries. That's probably 3R. Maybe 4. Done. I love the entries that this thing is making. I hate the exits. I may have mentioned that before. It's like,
Yep.
here's the mindset I want you to have. So I had a guy from France, and he could follow the exit rules that I get once I put him into the position. So I just did it this way. I said, look, here's a position. It's do not let it go below the red line. Let me draw this, and I'm just going to talk you through this visualization, if I may. Let me find where you're. Let's see, George. And it was sort of the basis for visual box trading. All right. It was like, here was a risk. And so here was his entry. And I told him, I said, oh crap, I'm in the trade. I need you to manage it for me. And here's the rules. If you let that close below that red line, then you got to pay me whatever the loss is below that red line, you got to pay me because you're not following my rules. But if you exit anywhere north of that red line, you don't owe me anything. And if you exit above this green, above the green line of the entry, you get to keep half of whatever we make on this trade. And so I would just get an entry, and it might be 1 or 2 bars in. 2 bars in is fair. It doesn't even matter how much. And that was the deal I made him. I said, look, you're in this position right now. If you exit north of this line, you get to keep half of whatever that trade makes. But if you let it go below this red line, you got to pay me the loss of my money. And if anything is in here, you don't win or lose anything. Free lottery ticket. So he was very motivated to never let it go below that red line. And with a 1, 2 bars in his favor, he always closed a winning trade 100% of the time. So like on this one, I love that entry. It just broke below here. That's the start of a move at the start of the day. And it gets smashing down. And now I'm already on alert because it made a higher low. Crap. I'm not going to let it go above this line. I'm going to preserve that much win by exiting here. And now it mucks around. The R10 reverses. There's your P1. That was a non-trivial move. You just entered you just entered the Red River. That's a perfect SSC. If you waited for this one for a COTA 2, I'm not offended by that. But your stop has got to be here. So if you get the SSC, there's your risk box. If you get this one, there's your risk box. And now I don't even care if you take that one or not, but when you get to here and this thing gets up here and then crosses down below, as soon as it goes below there, I'm noticing the skin of the dragon and that thing rolls over. I'm out right here. And there's my trade. So I love the entries that this thing is making. I don't mind this entry. That's a nice COTA 2. It didn't work. I'm out right here for half an hour loss. I'd probably take that one short. And I'm out here for a half an hour loss. I'm probably taking that one long, or if I notice I'm in the chop, maybe I got to wait till I get out of the drone stage. But I'm not losing money that day. To me, the 2R trailing stop on the intraday moves, I just it's too erratic. And CLF is a directional move. When he makes a directional move, it's fake 1, go 2, and then he's done for the day. So I think the exit rules have to be reflective of the kind of moves that thing is making, and giving you specific information about the you know, how much money do I have in hand? When is it my money? Don't let winning trades become losing trades. Respect the dragon. That kind of stuff. That's where I think the evolution of the system has to be. The
Yep.
identification of really good entries, I think you already have. But I just think the pattern-based and rules-based exits and before I committed to just having an idea and then back testing it based on rules without inspecting charts, I don't think that works. That doesn't work for me. I have to be able to look at the way I'm trading and make the decisions I make. And then when I'm consistently winning on my human interpreted rules, then I will write the code that turns that into a robotic rule set. But to me, the 2R trailing stop doesn't make any sense at all, because my average win is less than 2. I mean, think about what that means. My average win is less than 2R. So that means if my average win is, let's just call it 1R, if my average win is 1R, you know, here I took the risk and I was aiming for 2, and now it gets to 1R and a little bit beyond, and then I end up getting back. That means most of the time I'm not getting to 2R and then coming back a full R, or maybe I'm just barely getting to 2 and coming back to 1. So if my average win is 1R, that means, and my win rate is 50% or 60%, that means every one of those trades that was an average or less would now become a losing trade, because it's going to come back 2R and get me out below my entry. I'm taking my winning edge and allowing it to go negative. I'm not surprised when that is not coming back with moves, because it's unusual to get more than 2R in a straight line move, right? I mean, think about if this thing went 2 and then came back 1 and then went up 2 and came back 1 and came back 2. That 2R trailing stop would be brutal on that. So I just think you got to respect the system that's given you these entries, and then look at ways of interpreting that turning point in the RL10.
Yeah, I'll work on the exits next. Again,
So that's where I think we got to go with that. Make sense?
got it. Yep.
Okay. Next man.
I'll
Hey,
go ahead and go.
Yeah, while we're waiting, make sure you listen to the session we did with Sundeep on Sunday. Really good. I mean, really good. Especially for swing trading.
You mean Ahmad Ken?
Yep.
You guys seeing that?
Got it.
My personal check-in is I'm feeling better. Been off chemo for a few weeks and I'm starting to have more energy. That's good. 3 weeks to go till I'm back down there. So hopefully it's a good 3 weeks. I did a mea culpa a while back that I thought that those really good results I had shown you guys might have been wrong. I showed them to y'all. We did the analysis about an hour before the meeting, and I gave a caveat, but the perfectionist in me knew not to say or show anything, and I got burned, and I'm just like beating myself, but not really. But I hate that it's on film. So, Ken, I'm gonna have that tape of the last 4 weeks ago meeting splice me out of that spot.
Okay.
I'm joking, but turns out I hadn't spent the time with Everett I needed to, and he was double filtering the 6 months prior rolling window, and then he reapplied it to the current month. So he basically was filtering out look ahead bias, filtering out all the bad trades for the current month that you couldn't know, real time.
Yep.
So I'll show you the results in a second, but suffice it to say, it went from 1,000 R down to 300 R, so over 4 years. So
Still a
Uh,
good problem to have.
yeah, it's not like it's just completely negative. So
Yep.
I got to put it in perspective. Quant Connect, I've actually had it now working, paper trading, and then doing back tests. And I have a position sizing algorithm in. And I already kind of mentioned this before, but it's becoming more obvious that the system one capacity on the 30 minutes the capacity is just, it's limiting, meaning, if you had $100,000 account, you were going to trade 1%, for example, you're only going to be able to trade 3 out of the 5 or 6 symbols that it's trying to take during certain days. So you could still make the 700 R in 4 years, but you are limited as to how large you can make your R. And yeah, I know you can do
Got it.
some
Yep.
leverage and things like that, but again, it's a common sense problem and nothing new for you guys that have been doing it for a while. But this system seems to be running up against that. So I'm going to tune the Quant Connect position sizing a little bit. It has the ability to real-time size as it does the back testing. And so those results will give me a more realistic results. And then I'm going to continue looking at loss limiting measures for system one. This week, I'm going to rerun market system analyzer for system one on the SMA 20. That's what I'm going with. That's the stock PRX crypto system on the 20-day SMA. No market classification. And again, looking at figuring out position sizing. And then I'm going to continue to look at some other options. Kenya gave me the good idea of looking at the weekly loss limit, just stopping trading if I hit a certain R loss that week. I know, Juan, you've looked at an RL30, SMA 30 crossover market classification. We've had a conversation about that. I'll probably have to talk to you again about it. And then exiting non-profitable trades at end of day. I'll have to do that in the Quant Connect system. So that will require a little bit more programming, but that's good. And then I'm going to start researching system two. That's the one that Luke's tortoise flip system. So without beating it up too much, this is the SMA 20. So this is the standard PRX system. And I took the 20 trades that had performed the best off your list, George, which was basically off of Ken's, and looked at it 2 different ways. This is 20 symbols, looking at the top R, and the coin symbol is in there because it was only half the time. So if you double it, it actually would have been in the top group. So there's kind of a natural break on the R, and then also filtered it by expectancy then. And again, the expectancy has more symbols. So the one on the right here is the expectancy. It's trading 11 symbols versus I think 8. So it does have a higher net R gain. 0.21 expectancy versus 0.24 for the just looking at the R returned, the raw R on those symbols. And the big thing I'm looking at is the drawdown, 12% on one versus 6 on the other. So again, from my earlier experience, looking at drawdown also being a limiting factor, I'm going to run both of these through Market System Analyzer and kind of look at what the returns would be with a small percentage R being risked, but compounding.
Yeah, it's going to like that a lot. I mean, you got a reasonable win rate.
I think so. Yeah.
It's a 2 to 3 coin flip, but it's paying 2.5 to 1 on both sides.
Right.
So it's going to like that a lot.
Yeah, they're both pretty similar, obviously, if you look at them. I'm curious about the drawdown. The pink symbols up above here are the 3 that I didn't include, that are in the other side. And so, my anticipation is if I analyze the trades, I'm going to see that those 3 probably did contribute to that drawdown quite a bit, because it's less R on the left, 700 versus 860, but it has half the drawdown. So again,
yeah,
I'll see what,
and the size of the maximum R drawdown of 40 on the left-hand side against a net R gain of 700. I mean, that's 5%. That's not,
Yeah,
So the number looks significant, but not when you compare it to the, to
exactly.
the capture.
So anyway, that's kind of where I'm at.
Yeah,
Just as a-
market system analyzer is going to love that. I can tell you right now.
Yeah, good. I'm hopeful it will and looking forward to that. And then just kind of a post-mortem on this the market classification.
Yeah.
Ran it all the way down with different market classes at 200, 150, 25, all the way down to 10. That looked really the best. And so I had Everett run it at 12 and 8 as well. This is just a 8-day moving average on your normal classification, Ken.
Yeah.
That did give the best results, but you can see the net R gains down and the trades are way down. I mean, this is only 1,200 trades versus 3,000.
Yeah, but see, a market system analyzer is going to love that one too. I mean, the coin flip it's above 40%, so call 40% win rate, and it's almost it's 2.5 to 1 payoff. It's going to love that too.
Yeah. Interesting. What we're looking at on the right is just, this is the actual trades that were taken, analyzed after the fact. So a 6-month rolling window told us which market classes to take for the following month.
Yeah.
And you can see, I mean, it's not bad.
Yeah.
It has a 0.23 expectancy, but it's the expectancy is not any better than just the standard PRX system. And again, less than half the R.
Yeah, and that's going long, right?
It's long only. Yes,
Yeah,
sir.
yeah. So I mean, even if you just said, look, just don't trade bear markets and stay out of sideways quiet.
Yeah.
You know, I mean,
Again,
that's not an irrational point of view. Those
true.
are the market conditions that we do not expect to have winning trades. The only
Right.
bear that you think you could have a winning trade on the long side is bear volatile, because it's an SSC and it's a sharp
Yeah.
mover. It gives you your profit factor. Your trailing stop gives back some, but it still keeps you positive. But if you look at the average R value of just writing off the bear volatile, you don't even care that much about it. It's only
True.
6R.
Yeah, true.
It's
6R,
only
yeah.
6R compared to the bull normal, which gives you 35 times the payoff.
Right.
Done in one. Just don't trade it with bear markets and stay out of sideways quiet, because you don't have enough evidence that there's a swing trade waiting to happen.
Right.
And
Right.
if it does happen and you didn't take it, you're going to get the kata 2, at which point it's out of the sideways and it's up into the bull. So you give it the first trade coming out of sideways quiet.
Hmm.
And I would tell you that's tradable right now. You
Yeah,
eliminate,
if this was
just
the
put a
only
rule in there.
system,
Yeah,
yeah,
put
if
a
this was
rule
the
in
only
there that
system
says
I
no
had,
bet.
I'd be
Yeah.
fine with it. You know, when you compare this though to
Yeah.
this guy or even this one, I mean, either one of these, I mean, this has a 0.24 expectancy over 3,000 trades.
Yeah.
And this has a 0.23 over 1,200. So, I mean,
And that's including the losing ones on the bears
yes,
and the sideways quiet. So if you got rid of that, that would probably boost it up
that,
to have a slightly
true.
better expectancy.
Yeah, that's a good point. Actually, I'll run it that way just to kind of see what it looks like. You're right. It would look a decent amount better. I mean, especially sideways quiet.
It's not, yeah, I mean, it's not that much, what you're given. Your trade free, you're only giving up, let's see, 70, you're giving up 200 trades, and
Hmm.
you're not experiencing 20R. It saves you 20R over 200. So that's 200 trades that had a expectancy of minus 0.1.
Right.
So when you take those out of there and you rerun the expectancy, you're going to see the expectancy of that thing up around 0.3.
Yeah, I'll take them out and run it in Market System Analyzer as well and just see how that goes. So I'll have three
Yep.
results to look at. So anyway, so that's it. Thanks for the input.
Cool. Cool. Sundeeper one, jump up.
All right, hi.
You want
So Yeah, I had a rough week dealing with position sizing. I got unexpected results that I starting to understand now. And found I've been trading. I've on my sixth trade, and I'm up like 0.8 R. And when I downloaded all the trades of the backtest, I got this. Where are you? Share screen, Excel here. So the problem that I was having is that I was using position sizing separate than execution risk. And I was using the frog to calculate my position size, thinking that maybe the frog was much bigger than the execution risk. And it was not true in most of the cases. It was opposite. So I was having very big trades that was producing very good results, but unexpected position sizing. Once I correct the position sizing, I moved from 0.27 to 0.20, and all my trades moved to the left. And I was not expecting that, and I'm dealing with it. Probably using position sizing, a variable position sizing would benefit the system on different market types or different situations. And I had a question on the analysis of the wins and the losses. So I had my standard deviation of the wins pretty high.
Yep.
And the losses much lower.
Yeah, that means you're letting your winners win. So you're getting much more variability in the size of the wins. And it is disciplined at cutting losses. So all of your losses tend to cluster in a very narrow range under control. So that's going to have a small standard deviation, and that's what you want on the losing trades. You want a consistent small loss. What you want on the winning trades, where volatility is in your favor, you want a larger standard deviation, because that is being influenced by large winners that are contributing an outsized value to your net profit. You want upside volatility. The problem in standard system analysis is that it treats volatility to the upside as implying volatility to the downside. That is incorrect if you have rule sets that protect you against outsized volatility. Now, in day trading, that's a true statement, because you have a continuous price signal and it moves a certain distance. You can chop it off and you never experience the outsized loss on a single trade, with the exception of a information system collapse or a market meltdown that trading stops and it moves against you, and they issue you some flash crash loss. Okay, so that happens one day every 3,000. But the overnight trade, you can get more than 1 R loss because of the possibility of overnight gaps. But under controlled conditions, like what you're doing with intraday trading, and you have a volatility-based stop, you're cutting that off before it becomes an abnormally volatile loss. So the standard deviation is going to be small compared to the size of the win. As an example, your best win was 18, your worst loss was 6, done in 1. That's what you want. I mean, you want a win to be minus, you want your worst win to be -1, but because of some gaps probably.
Yeah, those are
Yeah.
our gaps
Yeah,
in.
so you could, I mean, you can live with that. What you want is a different profile of your winning trades because you're letting them continue to grow. Whereas if it was a losing trade, you'd be cutting it off. But you're getting this on some trades, you're getting that second and third leg that lets you get up to 18.
Hmm.
So that 118R win allows you to cover 24 typical losses. Your average loss was minus 0.7.
Hmm.
When you get that one outsized winner of 18, that pays for 24 routine losses of 0.7. And you can count on, with your standard deviation so low, you can count on, you have a controlled loss rule set. Your rule set is producing manageable controlled losses.
Cool. Thank you. Yeah, and in the SQN, I noticed what you were saying last time, that on the losing, it was very high because the volatility was low. So 15 and 10
Yeah.
on the SQN 10, and the other one's a little bit lower. Oh, all right.
Yeah.
Cool. So this is where I'm at. I started looking at the compound critical states, but I found this issue and I've been concentrating on that. And I had a couple of bugs on entering short.
Now, how many 355 total trade, or no, I'm sorry. What was the total number of trades?
In this case, I had 355.
Yeah, okay. That's so.
No,
That's total R.
It's like 700 trades. Where is the
Where's
number?
the number for 700?
Oh, no, I have it here.
Okay.
Trades.
And the 700 trades over how many days?
No, it is 357. It is 3 years,
So that's one trade a day. Okay.
something like that. Yes. So that's what I have. On the position size, is there anything I should do, or
Well, yeah. Here's what, just
Yeah.
measure the quality of the system strictly on execution risk.
Hmm.
Just whatever the execution risk is, just measure against that. Make a separate decision on how much capital you put on it and use that as a percentage of total portfolio. And that way you separate the dollars at risk that are appropriate for a system that captures R at a certain degree. But you're going to make a separate decision on how much money to put on there. Use execution risk for your position sizing. That's what we're going to do.
Okay. All right.
So
That's
just
it.
just measure execution risk for calculating system quality number. That system quality number and the characteristics of the numbers of trades and the size of the trades is going to tell us how much money per trade you're going to bet, and you're going to use a standard bet size on it. And then when the forward testing with skin in the game produces numbers consistent with the back test, then you know you can start scaling up the risk per trade in dollar increments. Do that.
Okay.
That'll simplify your life. Because you're mixing right now the volatility of the PSAR gap and the volatility of the frog box size, and it's clouding the results of R capture. So whatever you're using to measure execution risk, express the positive R capture in those units.
Okay. So yes, on execution R.
Yeah,
Got it.
execution risk only for assessing the system. I was not as clear as I should have been on that before. I see what it's doing to you conceptually. So purely execution risk. And then what I do is I take what 1/5 of the position size that suggests.
Okay. And
I
that's
just,
the
I just
amount of
multiply,
money.
whatever the execution risk is, I multiply that by 5 for my position sizing.
Got it.
So if the execution risk was 20 cents, let's say I was going to risk $100 per trade on every trade. And the execution risk on this next trade was 20 cents. I would multiply that by 5. That makes it $1. I would buy 100 shares. Done.
And one last question around that subject. Is there a threshold that you wouldn't trade if your execution R it's more than X amount, you would say, I won't take this trade?
Nope. Nope. Because it's geared towards, when you're using the RL10, that's the purest form of price. It's denoised, it's smooth price, and the size of the PSAR box is the size of the uncertainty zone. That's it. That's exactly what it is. It is the properly sized risk box for that trade situation. And even though it's small, that's why I multiply it by 5, so I don't even have to worry. But if you think about what it takes using the RL10 as the price number for the PSAR, and the PSAR gets way, way narrow, that means it had 30 or 40 or 50 bars of almost no volatility to get down to that, and then a quiet shift and reversal.
Mhm.
It had 30 bars to fail and it didn't. Now it's reversing the other way. That could be the start of a slow mover that then explodes to the upside. And you had the smallest risk box you could. That's how you get an 18R win, which pays for 24 of the next losses.
Mm.
That's how I think of an 18R win. I treat it as a 2R win for my portfolio, and then I bought 16 1R losses, paying it forward as a cushion.
Yeah.
Or take the 16 excess R's, take 8 out of the system and put it in your long-term system. So you don't lose your mind starting to expect 18R wins.
Yeah, it was like one-time thing. All right. Very cool.
Yeah,
Thank
and
you.
most of the time on that one, most of the time you're not having that problem anyway. You're getting some, 20 trades better than 3.5.
Yeah.
And 100 trades better than 2. I mean, that's pretty good. I don't like the size of your bins. The distance between 0.2 and then 2, 207 trades at 0.2 or 206 trades at 0.2 and 1 trade at 2R looks different, but you know what I mean? I'd make that increments of half an R.
Half an hour, half a standard deviation. Okay. Yeah, I have them by standard deviation, the bins. Then
Yeah. Those bins are too wide.
So I can make 20 bins of half the size. Right?
Yeah, I would use bins right at the Z-score markers, 0.51, 1.52, 2.53.
Mhm.
I mean, you can, so I mean, see what that actually looks like.
Yeah.
So when do you get a chance to do that?
Yes, I will. It takes a little bit to
Yeah, I get
the
you.
whole thing,
Yeah,
but
I'm with you.
it is.
That
All
will
right.
give you a truer reflection of what those things are producing.
Perfect.
It's actually going to make it look better, I think.
Well, Carlos, I wanted to see a chart.
This one?
Your charts are so beautiful. I want a screenshot to use as my wallpaper.
Yeah.
Yeah.
All right, let's see. Sundeep, go ahead.
Thank you. Bye.
Okay. So if you stop sharing on Carlos,
Yes, there.
So can the question is somewhat similar to what Jonathan started with. I'm looking at I'm learning to use the 30-minute patterns
Yeah.
for the strategic decision making, but taking
TF, is that are you
time frame.
IWM? Oh, time frame. Okay. I was
Time
thinking,
frame, sorry.
I thought that was
Yeah.
the Russell small cap. And where did that come from?
No, time frame.
right.
30-minute time frame patterns, but the entry exits of 3-minute time frame.
Yep.
So, and the question is like, how do I ignore the noisy signals? So
Yeah, here's the best way to do it.
okay.
Find an SSC on 30-minute.
Okay.
And then trade the COTA 2 on 3-minute.
Okay.
Because you have a significant event in the 30 that's now starting to, it reversed enough to justify an entry. And then when you look on the 3-minute, you'll see that it already had its SSC and probably is doing a COTA 2. So let the 30-minute SSC tell you that you just had an extreme move on the larger time frame, and then you drop down to 1/10 of that time frame, and then try to get the COTA 2, which is already building in some successful moves on that time frame, and it's still early days in that move. The advantage of that is that sometimes you might go 2 or 3 days in between SSCs on the 30-minute bar. Where you're most likely to see an SSC on a 30-minute bar is after an adverse gap that morning. Because that will be huge sell-off, which you treat as a big red candle, and then it quickly finds support in the first 90 minutes. You might get a 1, 2, 3 entry on the 30-minute bar, which means that it had 2 higher lows after the big sell-off. When you look at a 3-minute bar, you're going to see an obvious COTA 2 in there somewhere. That will get you out of the noise of the 3-minute, and you'll be good to go.
Okay. Perfect.
And it's kind of the same thing on the other one. Like you had a huge gap up and it doesn't follow through and it starts rolling over. You get a 1, 2, 3 or dragon horns on the 30-minute. Drop to the 3 and take collapsing dragons until the cows come home. And the dragon will feast. It'll close the gap.
Okay.
You're going to really like that. That little one you have right there on EWW, the second one,
Yeah.
is kind of like that. Is that a 3-minute?
The lower one is 3 minutes. The upper is 30 minutes.
Yeah. Now draw a circle on the. Oh, okay. I see where. Oh, I see exactly where. Now, what I want you to notice. Here's a piece of subtlety that comes from understanding the jump stop dragon skin exit. I'm going to show you something slick on here. Imagine that you were, where's my yellow? Yeah. Imagine that somewhere over in here, you had gotten some trade action and it was going up like this, and you were enjoying this big move, another big bar, beautiful signal bar, up doji, super doji, one little move, selling little doji, true doji. You can feel how that thing is starting to come to a point, right? Here's where the R10, if the R10 was on there, you'd see this is where the R10 reversed. So that means this is your exit for this long move, right?
Yeah.
Because when the R10 rolls over, your stop, which had been at the PSAR, jumps up to here, and that tells you that this outsized move is over.
Mhm.
You know what that means? That's almost like an SSC. That's this SSC. So the next way to deal with the noise is after a directional move, and then it noises out up here, and the skin of the dragon is your alert to drop down to the 3-minute and then crush that short.
Yeah, okay.
And where is it going to come back to? It's going to come back to the rising spine of the, that's, I don't know what that is, but there's the spine of the dragon.
Yes.
And it might come all the way down to the PSAR like it did. And that's the kind of move you're going to get. So that little signal, the end of the last abnormal move, is an alert to the start of the retracement move.
Got
I
it.
I get out here because it had its opportunity to continue and it didn't. The least surprising move is a 50% retracement of the abnormal move. And if I can get an entry somewhere in here and capture this move here on the 3-minute, it's going to look like that, and you'll crush that because the size of your wrist box is only here.
Yeah.
And there's 1, 2, 3, 4, 5, almost 5 wrist boxes just back to the routine recovery. So that's how I use the 30 and the 3. The end of an abnormal move on the 30 is an alert to the 3 for the other side, the first move out.
Okay, super helpful. Yep.
What else?
I'm good with that.
Okay. Are you using TC 2000 at all?
I am.
Do you have the bundle?
I do.
Give some thought to what I said.
Yeah,
I was
Yeah.
thinking about Mark Holland,
yeah. Okay.
but if Danny's willing, I'm not going to pressure Danny. It's his intellectual property.
Yeah.
But it would hurt my feelings to think that we had that amazing toolkit. And there
Yeah,
may be
I've been
there
I've
may
been-
be something that we can do with that.
Yeah, no, I'm happy to chat more about it.
Yeah. So I'll talk with you and Mark and Danny on that one.
Okay.
All right, fellas. Hey, I want to highlight a couple sketches that I drew. Actually, let's see. Yeah, let's see. Well, where's my whiteboard on this thing? I'm gonna see if I can do it with a whiteboard. Let's see. I wanna. Slowly loading. It got to we were talking about risk management. And one of the ideas was like a tachometer. There's a movie you should Ford versus Ferrari, to understand and feel the driver's control of that car. When he's looking at that car, he's listening to the sound of his engine, but he's watching his tachometer. And there's his red line. And then he's shifting the gears on his console in order to use, to get the leverage. And so there's some on a particular system, there's a zone where you feel safe because you don't have any position size on at all. I'm hiding. And then there's a red line in danger. God, I don't like this whiteboard. Trying to draw the letter R. Danger. And then this one is comfortable. I think that was the word I used with Danny. And then alert. And it was sort of like based on market conditions and where you are in the expectancy of your system. You know, the Nürburgring looks like this. You know, something like that. I don't know. But when you come out of the SSC or something, on those long straightaways, you got to be accelerating when things are all in your favor and working your way up to keeping the engine going powerful with a high gear so that you can max. And then as you're seeing the road signs and the expected turns, you gotta drive the curves differently than the straightaways. And there are times under market conditions when I'm in I'm in my little wagon train going across the damn prairie, and I have scouts out that are protecting me from the side. Oh, come on. Each with his little area of responsibility for the market or whatever. And those scouts are out there looking for food and safety and security. And when they find food, they bring it back and they put it in the wagons. So they're not just eating and looking, they're also finding food and whatever, keeping us safe. And that wagon, the trail boss, has to get us from point A to point B. And you can only get there by taking on the risk of moving. But there are times on the prairie, come out to Kansas if you don't believe me. There are, like we go outside when it's raining and snowing and all that stuff. That's just what you do. But when there is a thunderstorm and tornadoes coming, come on, pen, you're supposed to be drawing. That's supposed to be a storm cloud. I've got to be able to put this into safety faster than the tornado can move to me once I get the alert. So I got to have my alert out far enough that the speed of the tornado still allows me to go from moving to safe and let it blow over. But when it's just normally raining, I'm just moving along, maybe slower than normal. And when it's a really sunny day and things are good, I'm in the second half of that leg, I'm increasing my positions and I know what my maximum risk is, my portfolio heat. So those are the four categories. Maybe these are, you take every trade, but at half the position size, or you take half the trades with a full position size. I would take every trade with half the position size because I don't know which one's going to work. They all look the same leaving the station. And if it does start working, I can put the other half on. Done. And when things are really in my favor and it's sunshiny and beautiful, I can just take every trade with a regular load. So as you start thinking about how your position size scales, you have the line of production here. I'm in a production system and there's limited rate production and full rate production. That's supposed to be an R, full rate production. So maybe that's one normal position and that's half a position. $400 and $200 per risk. And then I got some kind of pilot out here and my scout. And that's going to be $10 skin in the game all the way up to $100. And as the numbers of trades come back, I get 30 trades in a row and it's still performing. I go from, 10 to 20 to 30 to 50 to 100. And then over in here, when I'm in the testing phase, I'm trading one share live, just so I can feel what it feels like with real money and slippage and all that other stuff, and see if it is performing with one share live compared to the back test and compared to the forward test paper. So what do I have? I have a back test, a forward paper trade test, and then one share live. And if that still works, the test is over and I'm going to pilot test it or prototype it from 10 all the way up to 100. And if it's still okay, it's now approved for limited rate production up to full rate production. Once I get it to full rate production, now I'm using these 4 categories of general risk. And I'm thinking about it as I got my production in my wagon train going from point A to point B, and I only go to safety when there is a tornado coming. And then after the tornado, I start moving out carefully. That's the SSC. Take the SSCs at half your dollars per risk. Always use the same execution risk, but just trade half the dollars. Done. When on the COTA 2s, trade them with a full position size and a regular risk box. That's the most, and you're just trading that, and then you're paying attention and you're on alert for when you get close to your red line, which is your maximum open exposure, because that's when that sudden storm cloud comes and disrupts you when you are fat, dumb, and happy. Listen to that discussion with Hamad from Sunday. The graphics were better because I wasn't using a whiteboard. I was using the Zoom sketch on a screen instead of the shitty whiteboard. Anyway, we're at 8:30. And that's why you want to listen to that session with Sundeep. It was really good. And Chun Long has a coin flip that's paying 3 to 1. Or 2 to 1. Coin flip that's paying 2 to 1 with standard entries and the jump stop. He's crushing it. All right. That's everything I got. See you shortly.
Thanks.
Thanks.
See y'all.